important for money managers. I'm Jim Cramer with my partner, Jeff Marks. And for the next hour, we want to go over our portfolio with an eye toward the biggest, most transcendent story of our time. And that's the incredible transformation that is the AI event of the fourth industrial revolution. I first heard that term almost 10 years ago when Jensen Huang, the godfather of AI, took me aside and told me that that's what we're going to see, a fourth industrial revolution. He said it so convincingly that I kept many of you in Jensen stock, NVIDIA, for the most historic run of all time. And despite yesterday's ridiculous decline and today's sell-off, we're still there. At that time, and for many years hence, as an apostle of Jensen, I told everyone imaginable that the fourth industrial revolution was in front of us. And you had to be ready for it with the right stocks for the transformation. No, you couldn't lose your discipline and own nothing but revolution-related stocks. But you had to own a lot of stocks connected to it. You had to, what we call, overweight the concept, or you were not going to be able to profit enough from what lay ahead. I don't like saying what inning we are in on something as important as transformation of entire economy. However, I do want to point out that we are already far along enough that we know who the winners will be. We're also seeing companies that we thought could be winners, but are now showing up as losers, perhaps because of competition or perhaps because of poor performance. Still, others aren't winners or losers. They're what I call whiners, stocks that people whine about, but are just fine, thank you. We have a few of those too. We'd like to touch on every stock in a club meeting, and today is no different. I want to start with the fourth revolution stocks, and then we can go into the rest of the portfolio. And Jeff, before we do, I do want to point out that I'm not oblivious to what's happening today in the market. We're obviously having a day that reminds me a lot of Monday, where people sold a lot of stocks because of what was frankly a note, a letter, a theory that what's going to happen is it's going to wipe out many jobs. You know, I think it's the exact opposite. It's going to create the most jobs.
Yeah, and what Block, formerly known as Square, announced last night, that is resparking those fears of significant layoffs. And I guess what that piece also fails to mention, though, is that there will be jobs created from AI. I know we hear it a lot from Jensen Huang. Other CEOs don't know exactly what it means, but there's going to be new positions created to manage all of these AI agents.
And I think that's why, I mean, the market was down very badly at the beginning of the day. We had the same thing happen on Monday, but it stayed down because people just kind of got very nervous. And then the market came back to life. And I think it's going to do the same thing today. Obviously, we're in a fulcrum position doing this, doing our club meeting, right, when I think the market could reverse. But it's very important that we have it in context and that, you know, like I said, we're doing what's behind the scenes. Jeff and I went back and forth this very morning before we came down here about what do you do with a block that is firing 40% of its people and the stock goes higher, or Dell, which is adding business and the stock is flying. Or I think what's really incredible is you can take a look at some of the stocks that we have, like a Salesforce, that can go down all the way that it came up because of this paper. After all the hard work we just did on what Salesforce can do. So I want everyone to know that we are not, we're paying attention to the market at all times. And we're not just saying, okay, we want to put on a show. It's no show. It's for real. This is the way we really are. So first, of course, when you think about the fourth industrial revolution, is NVIDIA. In our business, the narrative follows the trade, meaning the story. If the market goes down or if one of your stocks goes down, people suddenly make up the reason of why it goes down. And we have NVIDIA down today, and we had it down yesterday. And that was simply because the stock was driven down by what I call a motivated seller who wanted money out of sky-high hardware and into down and out software. And that, there we go. Stocks like Salesforce. Now, we went over that NVIDIA quarter with a fine-tooth comb, and I can tell you it was stunning and clear and exactly on point when it comes to the revolution that Jensen coined. I want you to pay no attention to others, including my own colleagues this morning, when I trying to explain why I think NVIDIA can come back. You need to know something. As much as I like to say we own NVIDIA, we don't trade it. If I felt otherwise, I would make sure you knew it. I am not thinking that at all. I am not perturbed by the action. NVIDIA remains the gold standard. It is the one that I care the most about. Now, we have a cluster of companies that are pleasant surprises, ones that took different paths to get into the portfolio. And Corning and Qnity, the 6th and 9th best performing stocks in the S&P 500 up until the close yesterday, are two that we spotted, and I am very proud of it, frankly. But let me tell you first how we spotted Corning. It's when I went to Harrodsburg, Kentucky, to the Corning plant where all the iPhone glass is made. Wendell Weeks, CEO, obviously there when talking to Tim Cook, but Wendell Weeks, the CEO of Corning, he was there, and he took me aside and told me a story about how fiber was going to replace all copper as a better way to connect the big racks inside of a data center. Do you know what we did? We went all in and told you about it because I thought the story was much better than I thought. I was shocked people figured it out. And man, has it been a great one, huh, Jeff? Don't you think it's just really exciting situation to Corning?
Absolutely, and we're still waiting to hear them secure more supply agreements with other hyperscalers. The one with Meta. Look, Meta is obviously being the most aggressive in securing their supply, but they're not going to be alone. I think others will come.
Absolutely. And then the other one that was a pleasant surprise that you and I talked about, and we look at it, sometimes we look at stocks way too much, but it's Qnity. And this is the material spinoff of DuPont that used its high bandwidth memory semiconductors in many other applications. Business is, as former DuPont CEO Ed Breen told us, just incredible. We waited for that spin. We had conviction, and it paid off with a huge hit, much more than we ever even thought we could get. Now, here it's interesting. Think about this. I met Wendell Weeks, and it was by chance that he recommended this. Ed Breen was retiring. He wanted to do us a favor. We had talked to Ed Breen for years, and he said, this is the one. So we do have some luck. We do hang out. We do get some things that you might not be able to. I'm totally conscious of that. And you know, Jeff, one of the things that I always tell people to do their homework and try to know as much, but I'm also cognizant we do have an edge. We do get to go out. We do talk to CEOs. It matters.
You talk to a CEO, at least one every single day on Mad Money. I mean, that always provides
usually two or three. And I
ton
know
of
that
insight.
I apologize to my wife who's just had tough knee replacement surgery. That I'm out. I was out all week with CEOs because this is what I have to do.
And is that how you shape your worldview? Talking to all the big CEOs around the world?
Yes. And for the most part, they're optimists. And they're optimists because it's very hard to be in business and not be an optimist. Yeah. So that's what I get. Now, here's one that I think is really terrific. It's Eaton. It's the premier way to connect the data center to the grid. It's a remarkable company. And it's been a partner also with NVIDIA for the build out. It just keeps getting better and better. Recently, it chose to offload its automobility business. That's a division that had been a drag, considering the change to the White House, of course. And it doubled down on the data center with the $9.5 billion buy of Boyd Thermal, a leader in liquid cooling. NVIDIA's devices burn very hot. Air won't cool them. Boyd's solution is best. Eaton's terrific. We know that the data center need power. You get power from turbines that run on fuels that generate electrons. So who do you buy those from? It's GE Vernova. It's the biggest natural gas turbine company in the world, and the U.S. is the largest producer of natural gas in the world. GE Vernova is also the best builder of nuclear reactors in the world, and it is building one right now in Ontario. We will need all the power we can get. This company will provide it. Now, let's get a little more attenuated, okay, when it comes to the revolution. We know there are many companies vying to take advantage of this moment to become dominant in their fields. We own Alphabet, Amazon, Meta, and Microsoft. These are all great companies, but they aren't equal when it comes to what I'm talking about, the revolution. Alphabet's best. It has the incredibly lucrative YouTube franchise, an amazing cloud division, a good self-driving business in Waymo, and a remarkable search business known respectively as Google and now Gemini. I think Gemini, by the way, is the best chatbot, even better than ChatGPT. I use it constantly. Alphabet is spending tens of billions of dollars on data centers. I applaud that. It's a revolution, for heaven's sakes. Don't sit it out. I want to buy more Alphabet. Just this morning, I should point out, they had a terrific semiconductor sale to Meta.
Yeah, that's what we're hearing from the information that Meta is going to rent their Alphabet's TPUs, which of course are co-designed with Broadcom. It's been in the headlines. It's good to see it's coming to fruition. It's a big it's a really a good sign of what Alphabet has been able to achieve.
Right.
That
And
they're able
I
to
don't
rent
mind
their
that,
own
look,
chips.
they have a ton of chips, NVIDIA. They've got millions of chips going to Meta. But this is very important. And I'm glad you mentioned Broadcom, because Broadcom's been down and out, and I think it's a good one. Amazon is second best. Amazon's web services business is excellent and accelerating. You know, I love Prime. The ad business is good. Amazon feels it has to go into debt to build out its data centers. I think that's fine. It does have a great balance sheet. I hate to see that destroyed, but they have to take down debt. We have enough Amazon. We don't need more. I will point out again that Amazon announced a deal this very morning with OpenAI.
Yeah.
That was very significant. They're partners now.
Yeah, and it's up now in today's trade.
It shouldn't have been down. See, this is what bothers me. I'm on air and I see it's down $1, and I just say, well, that's ridiculous. And I know it seems very gratuitous. I say things like that, but I knew that it would go up. It was good news, not bad.
Yeah, OpenAI is going to use Trainium, which is really good validation for their chip efforts at Amazon.
Look, when something's good and things go down, you have to correct the tape. All right, Meta Platforms is a little tougher. It looks to me that Mark Zuckerberg fell behind and is now buying as much NVIDIA, AMD hardware, and of course, I just mentioned the Google hardware. He's building out a huge data presence. I don't quarrel with him. He's too smart, and his businesses are too lucrative to worry about cash flow issues. He's really brilliant. And he doesn't get enough credit for that because everyone's kind of caught up in some of the other things he's involved in. Just suffice it to say that other than Michael Dell, when it comes to running a company, I think that he's that good. Zuckerberg is that good. Of course, Dell up 25 did today. Not my data. Don't own Dell. Wish did. All right, Microsoft. This is the one I'm worried about. I slept on this one. Didn't pay enough attention. It has the weakest AI business in that ridiculous Copilot. It sucks. They only have 15 million subscribers. They got 1.5 billion users. Its cloud compute business, Azure, I no longer think is the envy of the industry. I like Amazon Web Service more and Google. I'll be blunt. We should have sold Microsoft. So what kept us in? Google. That's what. See, not that long ago, we decided to dispose of Alphabet. We were concerned about the antitrust department's case, and we were worried about how Google search could stay competitive in the world of ChatGPT. So we sold it. And do you know that almost overnight, the judge who had ruled against Alphabet reversed himself, and Google teamed with Gemini to offer the single best search in the world. Microsoft, I fear, could pull out a similar rabbit out of a hat the moment we sell it. Is that a bad reason to stay with stock? No, actually, it makes sense. Microsoft management, they're not a gang of idiots. They're smart, fabulous balance sheet. They're teamed with OpenAI, which is no slouch. They just got a huge amount of money in. When it comes to AI, you want to be teamed with them. But this is the stock I worry about the most in the entire portfolio. If necessary, we will take action to preserve capital. It is too big a position. And you know, Jeff, it's very disappointing. I feel very disappointed in myself that I just let this go. I kept thinking, we can't have another Google. I also, of course, felt that Copilot would have been much better. They would improve it like Gemini improved.
Yeah. Well, at least with what we learned last quarter, where they could have posted a bigger Azure revenue growth number if they didn't allocate some of their compute towards Copilot, towards R&D, towards some other initiatives. If they learn from that lesson and just go all in Azure, you could see the stock perform better.
And the stock would go up 100 points. You know that. That's why we have to. Well, I don't know. We just have to keep watching. I can't say right here that we want to sell. There's too much decision-making that has to go on. But you correctly encapsulated a thing that could happen.
It's the ability to reinvent themselves, as you pointed out.
Exactly. Now, here's one that I got mad at, too, when I was having an operation on my eye. And this happened while I was away. Cisco. It makes the plumbing for the internet and therefore has tons of exposure to the revolution. It has a strong quarter. But it got dinged pretty hard because of memory costs. Memory is sky high. It was a strange moment, a triumphant quarter only to be hurt by the cost of the lowest end semiconductors. Jeff, I wasn't happy with it. Cisco, I know you feel that I shouldn't be too disappointed. The memory cost issue can be dealt with. Hey, Michael Dell dealt with it.
Yeah, I mean, look, Chuck Robbins did say on the call they are taking actions to pass through costs on, and they have large negotiation presence where they can use some of that leverage to keep their prices down. But they still managed to raise their EPS forecast for the year, not to the same degree as Dell did, obviously, last night. But I think the fact that they can still raise earnings despite those higher input costs, I thought the market wasn't giving enough credit for it. We did sell about 100 shares before the quarter.
Yeah, that was good.
Should have just rang the register on all of it clearly. But I do think the market is counting them out in what they can do.
I think that's right. Low multiple.
And it's cheap. Yeah.
Low multiple. Yeah, I speak to Chuck quite a bit. I couldn't be angry at him. I mean,
still up 2% for the year.
Exactly.
S&P hasn't done much, so it is something there.
All right, let's deal with Broadcom. They make all sorts of semiconductors that go into data centers. It has a software division, VMware, which allows for private artificial intelligence business for the cloud. Now, this one's been a big winner. It's also helped design a lot of chips for the other companies. But now it's not a winner, it's a whiner. It's got weak holders who fret that Anthropic, a private business-to-business AI company, might disrupt that VMware business. Why? Because it's high-margin software business, and all software is now regarded as vulnerable to disruption. Now, see, I'm confident that Hock Tan, the CEO, will pilot us higher, but I recognize that it's trying for many of you. It's trying our patience. Bears seem to just think it's just so easy to feast on. I don't like that. It's been a long time since we've had to worry about Broadcom. It was actually August a couple years ago. I still believe in the future. I think that Jeff, when I look at what Hock Tan has done, he's always confounded the Bears. I'm betting this is no different this time.
Yeah, look, we'll see next week with earnings.
Right.
That will obviously be key. We'll have to hear more about the customer ramps, not only at Alphabet, but maybe new ones as well. It's really a conference call stock. That's where the stock really makes its most moves. When you hear from Hock and the commentary he has about the outlook for the business.
Now, I know many of you don't have the time to listen to conference calls, and I totally understand it. Those who do own Broadcom, it's an explosive conference call because there are always things announced in it. So perhaps even if you can't listen to it real time, you can always get you can get a copy of it, and it's really good. The other thing you want to do is you get what's called the deck, which is the 20-page handout, and you listen to the conference call at the same time as looking at the deck, and I think you'd be very well informed. Okay, here's two more that became problematic just in the last month: CrowdStrike and Palo Alto. Earlier this week, I said up top we were treated to a paper that argued for a great recession in 2 years because of the job fallout from artificial intelligence. We started to hear doomsday scenarios for every single software company, including cybersecurity, which I regard as being a little bit separate from software. It doesn't matter. See, we know Anthropic said it was going to go into the business. That was enough to crush the valuations of both Palo Alto and CrowdStrike. I have been willing to accept that there's plenty of software not worth owning, but I didn't think that would get to these highly specialized companies that cannot easily be duplicated. I think if these two stocks were not so highly valued, with CrowdStrike being perhaps maybe one of the most expensive stocks out there other than Palantir, it wouldn't have mattered. And they would have snapped right back. Now, looking back, I should have been more aware that the long knives are out for anything software, even if they are indispensable, mission critical, and cannot be duplicated, which is the way I feel about CrowdStrike. That's why I only want to own one of these going forward, and that will be CrowdStrike, which I think has the most proprietary weapons to defend its clients from the cyber miscreants. I am not willing to toss CrowdStrike because of an Anthropic press release, though. I am, however, not as inclined as I would have at one time to buy it lower. Now it will have to be appreciably lower, as I saw what fear can do to these stocks. Jeff, it would be tough to sell. I think it would be tough to sell Nikesha stock, Palo Alto, because we've owned it for a long time. But I just feel we've got to consolidate. And I saw what happened on Monday, and I was horrified.
Yeah, I think that's fair. And some of that's replaying today with both of them down, CrowdStrike down more because of that high multiple, as you mentioned, a little bit more wood to chop there, I guess, so to speak, versus Palo Alto. But look, despite the issues, I still think AI will be a tailwind for the industry. Zscaler, by the way, reported last night a negative reaction there, and I think that's an important call out as well.
Okay, they
to what's
did
happening in cyber.
They were supposed to do 91 cents. They did 10 cents better. They had really good Rule of 40, the way to be able to balance gross margin and revenue growth. I thought that Jay Chaudhry acquitted himself very well. Boom, got crushed anyway. That's what we're dealing with.
It's funny. You think with Block laying off 40% of their workforce, that doesn't create some more cyber risk if just given the greater responsibility each employee will have and the agents running wild. I would think that would create a little bit more cyber risk.
George Kurtz would tell you that it's actually something that makes business very strong. George is very close, obviously, in corporate CrowdStrike, and he knows that there will be much more business because of the agents.
Yeah.
Because the agents can create a huge amount of data, more than humans, and George
they
defends the data.
Yeah.
That's what they do. They don't defend the agents. Yeah. They defend the data. All right, how about tough Salesforce? It's so low. It's 15 times earnings. It has a $50 billion buyback, and it's only a $180 billion company. It has a nascent agent business that I think will be the de facto way companies integrate AI. The possibilities of Agentforce are immense. I want to see if we can't get some momentum going after that last quarter. I think you go higher before I decide to do anything. I know it's hated, and it's simply hated because, well, it's software as a service. And Mark last night talked on the show about the SaaS apocalypse is 2 nights ago, which is that if you have the kind of business that he has, you're going to get destroyed. I'm not buying it, but I also am wary. The stock has been terrible. I'm not oblivious to the fact the stock has been terrible, but I think that yesterday the spark of the stock going higher may mean the spell is broken, and if we have to, we'll get out at a higher price. That's my wrap on it. Finally, there's Apple. You know me, I say own Apple, don't trade it. That's because it has the best product and the biggest installed base of satisfied customers. 1.5 billion people. I think its partnership with Google for built-in search was brilliant, and it brings in lots of money to Apple, more than the $20 billion a year. Now we understand it's going to have to give back a little bit to be able to get Gemini, all right? But it's still going to get a huge check from Alphabet. Gemini is going to be its chat service. Think about this. Everyone was blasting Apple for not having a good AI strategy. Now it's piggybacking on a company with the best AI strategy and not spending the tens of billions that the other revolutionaries are paying. The build out that everyone is so fearful of. If you were worried about the hundreds of billions of dollars that the hyperscalers are spending, like they are given to CoreWeave, which is down 20 points this morning, there was only one solution. You buy the stock of the greatest freeloader of all time. You buy Apple. It deserves its status. Only Apple can instantly make an AI competitor number one by teaming up with them. That's what it did to Gemini. I know what you're thinking, that it's an awful lot of exposure to one theme. But it isn't a theme. It's a revolution. And we want our share of it. We're proud of this part of the portfolio. And with a couple of exceptions, I wouldn't have it any other way. Let's go away from it now. Talk about our banks, Capital One and Wells Fargo. We have a handful of financials, and earlier this week, we read that frightening screed about how AI will wipe out the white-collar economy, taking down the credit card companies, too. It was a novel argument. It was reintroduced today because of what happened at XYZ, which is the stupid symbol for blog. And what's happening right now, it's crushing Wells Fargo and Capital One. We bought these stocks earlier at these levels a couple days ago. We don't need to go back and do it. We are grateful to the writers, though, for the opportunity you get to buy these two stocks at such low prices. I think both of these companies have worked hard to integrate artificial intelligence into their day-to-day businesses. Wells Fargo has gone as far as hiring away a senior Amazon Web Services executive to take that bank to a level that traditional bankers may not be able to understand. Good call there by CEO Charlie Sharp. Goldman Sachs, we see a high-quality IPO boom coming that will blow the doors off of all others. We have this going this decade, and Goldman Sachs will be the top underwriter. We see a wave of mergers coming that will dazzle us, and Goldman will be the top advisor, just where you want to be. But here's one that you don't want to be, and it's BlackRock. It had a good quarter. I know it has good technology, but it has a private lending business that I now regard as troublesome, not because BlackRock being a reckless lender, they're not, but because others in the sector have not been careful underwriters. There's the possibility of what I call contagion here, and I don't think any potential upside can offset the downside of guilt by association to others in this private lending business. I no longer think we need to have this, to have anything in this particular space because of other more reckless companies that are in their sector. It could be hurt. It could take even down the best operators. Am I a whiner on Blackstone? Perhaps. but I don't want the hassle of dealing with the hazards of some sort of tarnish, even if the company doesn't deserve it. Jeff, do you think I'm being too defensive?
No, I don't think so. I think, look, it's down 1% this year, so it's hanging in better, and it's because a lot of it is just these fees, a lot of fee-based models.
We did
right,
have a
from the
good quarter. We
inputs.
know that.
The quarter was great. Their last couple quarters have been great. But I also think, too, just given all of the headlines surrounding private credit,
Blue
private
Owl,
markets,
KKR, Ares, Apollo.
I think part of our thesis has also been about private markets entering 401ks, and maybe there will be some resistance to that happening, given some of these blips that have occurred. So something to be mindful of.
We don't need it. It's my take. We don't need it, and we'll talk about it after. Okay, we don't need it. All right, we own a couple of pure industrials that I really like. Dover. It had such a good quarter with good growth, and Rich Tobin, the CEO, has positioned the company for a lot of exciting bolt-on mergers and acquisitions. The community list DuPont is a bit of an old-fashioned conglomerate with two main divisions, water purification and healthcare, and I like them both. I think the CEO, Lori Koch, is ready to rebuild this $20 billion company, and we want to be there with her. I spent some time with her earlier this year, and I have to tell you, she has grand plans, and she's going to pull it off. And Ed Breen picked a good CEO in Lori Koch.
Yeah, and they had a great quarter the other week. For so long, the DuPont story was so muddled because they'd make these acquisitions and then they would sell some things, and you never really got a clear picture, a clean picture of how the company was doing. If you read that last conference call, it's a totally different DuPont. They're focused on, they talk about KPIs a lot, key performance indicators. Right. They're really focused on making the business better. And that's why you've seen finally a re-rating in the stock.
Right. And she's tough and well-spoken and really understands the new DuPont, which is what you need to do. You have a lot of explaining to do, and she knows how to do it. All right. So Honeywell. It feels like the DuPont Cuny story all over again. Soon Honeywell will be splitting into two, with a building and process automation segment and a pure play aerospace company. Both are really exciting to me because of the scarcity factor of both divisions. We don't have a lot of companies that do it. Either one does. Honeywell's automation business could be the next Rockwell Automation, probably better. The aerospace business has a huge amount of intellectual property in all of our big planes. When the split occurs, we will be rewarded, so stay long. By the way, Wolf just upgraded the stock to buy this very morning with a $293 price target. That's good. Sometimes when I look at things, I think we're the only ones who really love it. But this thing's really starting to get the momentum that you need going into the split.
Absolutely. The purgatory coming to an end. We can see the separation. It's going to be early this summer. The Solstice, which, yes, we sold too early. We sold it when it was making new highs, but we sold it a little too early.
We made money. We made money. Never regret anything you made money on.
But I think between that and what we just discussed with DuPont and Cuny, good proof points that these industrial conglomerates, they're just better when they break up. And it could be another one, too, when they separate mobility.
Right. And you have to understand, we're always looking for these. They don't come along all that often. But when they do, we look at the parts and think about what they would be worth individually. That's what we did with Cuny and DuPont. We had that $100 price target, but when you add them up, you get more than 100.
Yes.
So I think the same thing's going to happen to Honeywell. I'm urging you to stay long. Now, here's another one I want you to stay long. And when people ask me what the best stock in the portfolio is, often I say Boeing. Aerospace is one of the greatest bull markets I have ever seen, and that's why we aren't content to just own Honeywell. I know Boeing can be a frustrating stock to own, but I think this stock could easily trade to $300 a year from now. Yes, I'm that confident. Kelly Ortberg, CEO, is doing a remarkable job fixing the mess that his predecessors made. He will get us there. Finally, one of the best industrials we have ever seen is a company called Linde. That's the industrial gas company that we own for a long time now. It just keeps powering higher. Its gases have so many uses. I know I'm from Philadelphia. It's gas. I know it should be gas. I guess, right? Gas. The ones that are dazzling now are those that are used to make semiconductors and those that propel rockets, which is turning into an amazing growth story. I'd be concerned that the economies worldwide were too anemic to help push Linde's stock higher, but I'm feeling really good about its mosaic of carbonation, oxygen, and hydrogen, among so many others. Jeff, you know how well run this one is. Jeez.
Yeah, absolutely. And I keep pointing back to and the stock didn't have a good year last year, but when the CEO, he bought $1 million worth of shares right around where it was a 52-week low, came on Mad Money, reinforced that this 10% earnings growth per year algorithm is still intact. I think it has benefited from flows back into what we describe as halo stocks, heavy assets, low
I know, I was going to put that in. I thought it was too insider, but yeah.
But I think that matters too. But that's why Lindy,
right.
It's up, call it, 17% year to date, making new highs, and just a very well-run company.
Hey, speaking of well-run companies, the next one is TJX. Look, I know that Walmart wowed many people that last quarter, and they're taking Walmart up again today. But the finest quarter in retail, I think, came from TJX, which is a juggernaut. Right now, we have several retailers that are reorganizing, meaning, bankruptcy, giving TJX a chance to pick up some terrific merchandise for its stores. They come in with cash. They say, we'll take the stuff. Very few retailers can maintain the consistency that TJX gives you. It's about merchandise, and they are the best. Home Depot is our chit in the interest rate cycle debate. I believe our soon-to-be Fed chief, Kevin Warsh, will cut rates aggressively. I think it's kind of like, well, this is what you get. He tells the president, this is what's going to happen. And when he does, you need a home builder or a retailer that caters to renovating and repairing homes. Now, right now, Home Depot is really not, it's just fine. It's a whiner stock. We had an okay quarter. But its stock will take off well in advance of when business gets better because of lower rates. It fits the bill of every large portfolio manager. He seeks or she seeks a play on the rate cuts. And I can tell you Home Depot I'd say for the last 30 years has been the play that people do. It's the big one. Okay, how about Costco? Lots of people have cooled on the stock of Costco because its premium price to earnings multiple. They say it's just too high. But don't look now. Walmart stock is almost as expensive. It is true that Walmart has become a much bigger competitor to Costco than I ever expected. I still think the world of the company, though, and I recognize that with food inflation cooling, and it is cooling, okay? And you just have to look at the categories. Costco can avoid any real negative surprises. We are monitoring, more importantly, though, the re-ups. This is what really worries me. What percentage of people are re-upping their club memberships? I don't want to see any further tick down. And I want you to know that I am not wedded to any stock, even if I love to go to Costco and we've owned it for a long time. We have to see improvement in the figures that are about re-upping. And any further slippage may cause us to reevaluate even this stock of the great company. Now, I'm trying to present how rigorous we are about this. Carl asked me the other day, Jim, with that re-up number, are you still liking Costco? And I had to say, look, unless it gets a little better, no.
Yeah, at least more recently, the comps have just been so strong. Yeah. It's made up for what we've seen in renewals. And of course, the renewals are happening because of the more online signups, which we knew at a lower rate. But with the quarter, last time we heard, I thought there was a little bit more of a sense of urgency from management that they need to start taking action to fix this issue. So we'll have to see their ability to execute in this 3 months.
Yeah, someone lit a fire to the CFO.
Yeah.
He's the old CFO, Richard Galanti, was the fire of the whole company. I felt better after at the conference call. I thought it was good. All right, Starbucks. We are dealing with, this is amazing. Do you know that we're dealing with 4 separate comeback stories versus Starbucks, which I think is really coming together. Brian Nickel got a terrible hand, but he's augmenting it and doing it in a fashion that one day will produce incredible results. So I think we're already going to see some. I think we've had some good comp numbers. We're going to see some great comp numbers because of refurbishments and closure of weaker stores. Here's one that just, I don't know if it got away from you. We were lucky to get some in Procter & Gamble. I got a new CEO. I think the stock's anticipating big changes from the CEO. So am I. Plus, it has a weaker dollar, probably the big cap stock other than McDonald's, where that weaker dollar matters the most. I don't want to trade out of P&G just because we are up a lot from when we first bought stock. I want to see what the new CEO can do. It's been dormant for a long time. I'm beginning to sense a revitalized P&G right in front of us. And I don't know. I don't want to pay 163, 164 for it, but someone obviously wants to. It's really doing well.
Yeah, up again today, 166.
Is it 166?
166.
That's crazy. Wow. Well, nothing. You know, nothing's been said. This is one of the things that's really hard about the business. Nothing positive has been said about Procter & Gamble from 142 to 166. Nothing,
Yeah.
okay? All we've heard is negativity. We bucked the negativity because we realized that the products are good. That's not going to change. They need a new CEO. And it's sometimes just like that. You have to go against the prevailing wisdom. We had missed PepsiCo. That crushed me. And I wasn't going to miss Procter. I wasn't. And I know I jammed it on the sheet, so to speak. That means I just said, look, I don't have the strongest case, but you got to own it.
Yeah.
I had read through the last couple of conference calls. I talked about the conference call in my last book. They had a very incoherent conference call. I knew it was time for change. Suddenly, a new guy, international. I think we got to watch him. I think he's real smart.
Yeah, and we talk about the concept of portfolio management all the time, right? That's what we're trying to teach. And when we were buying Procter, even as it was hitting new 52-week lows, it was just on the idea if we see a reversion from the tech trade that has dominated the past few years, the hated consumer staple group would be a likely beneficiary of that. And that's played out this year. Procter, no organic sales, core organic sales growth last quarter, but it's been rallying since.
Well, I know it must bother people at home that the only thing I relied on, remember I said that I'd gotten to meet Weeks, so I was able to come up with Corning. The only thing I relied on when Procter & Gamble was my history. I knew that Procter is go-to. They meaning the big growth guys, they buy Procter, they buy McDonald's, okay, and they just close their eyes and they buy PepsiCo. PepsiCo I missed, McDonald's I missed, did a piece on last night. I was not going to miss Procter. And that's why we own it, just because I didn't want to miss it. All right, here's one that sometimes I think I wish I had missed, Nike. I know that Elliott Hill's doing his best, but boy, oh boy, this is a game of catch-up. Not only did Nike fall down under the previous regime, the other guys got stronger, much stronger. Deckers, I'm wearing Hoku because I have a twisted, I rolled over on my ankle, so I wear these silly things. People think, wow, it's fashion forward. No, I'm trying to get. Well, it's actually my left one, but they look the same. But anyway, it's become people. Other guys like Deckers have come on strong. Hey, by the way, New Balance, even Under Armour. Under Armour had a great quarter. We're going to have to see something soon. I'm staying close to this one. Have to give it some time. I just wish there weren't so many holes in the bucket, including China, which has got to be solved. And then here's one that just I think good luck or maybe dumb luck. And that's Bristol Myers, which out of nowhere is showing signs of life in its cardiovascular product line, which has really been dormant. We're waiting for readouts, though, of course, of the novel antipsychotic Cobenfy. I still think that this one's not my finest hour. But you know what? We got a question in the wings about Eli Lilly, and I console myself now that we're in spring training by saying, well, we got one out of two. That's not bad. All right, now I want to bring in Jeff to talk about a bullpen addition that gives us some diversity and growth at the same time. Go ahead, Jeff.
Yeah, we always no new names in the portfolio since our last call.
But we always try some.
But we always try and give you at home a new idea to chew on as we do it ourselves. And this is a new bullpen name. It has minimal economic sensitivity and faces little to no AI disruption risk. We are adding Cardinal Health, a company that is the backbone of the U.S. healthcare industry. It's a healthcare services and products company that plays a major role in the healthcare supply chain and by supplying and distributing medicines and medical products to a wide range of healthcare providers. It buys prescription drugs from manufacturers and distributes them to hospitals, retail pharmacies, and clinics. It manufactures and distributes items such as surgical products, examination gloves, and other medical products and supplies. And it also provides healthcare services and solutions, including inventory management and supply chain support. Cardinal Health operates in an industry that effectively is an oligopoly dominated by three players: Cardinal Health, McKesson, and Cencora. A significant long-term tailwind for the business is the aging U.S. population. Over the past 30 years, there's been a consistent increase in the number of Americans over the age of 65. As Cardinal Health likes to point out, when you are over the age of 65, you have more than a 50% chance of taking 4 or more pharmaceutical products. And if you're over 65, there's a 5 times factor versus under 50. So Cardinal believes there will be more Americans over the age of 65 each and every year for the next 30 plus years. And that's a significant long-term tailwind to its business. That won't change with what's happening to the broader economy. It's independent of that. It's an incredibly economic resistant stock. So is there an AI threat here? That's a question we have to ask ourselves every time we buy something now. The stock did sell off hard on February 12th alongside the logistic and transportation stocks after a very small company announced a new tool that aims to reduce freight inefficiencies. It created some worry that the drug distribution companies could lose some pricing power. This was a classic shoot first, ask questions later reaction, and the stock quickly recovered those losses. The market realized it was wrong. Artificial intelligence poses risks to many, but it will also create meaningful opportunities for others. Analysts at Barclays quickly came to Cardinal's defense, arguing that if wholesalers become more efficient in their distribution operations, it would be a positive for the group, with the cost savings accruing to the distributors. Now, the stock has been a huge winner over the past 12 months, and it's up about 10% year to date. But it still only trades at 21 times calendar year 2026 earnings. That may look expensive relative with history, but it's re-rated due to its consistent double-digit percentage earnings per share growth per year. By the way, it's actually cheaper on a PE basis versus Danaher, which we finally sold out of yesterday after a disappointing few years. So it's a name we're looking at. Stock's trading, in the relatively around its all-time highs, but if we get some volatility in the markets here, I would expect us to pull the trigger.
I mean, Jason Holler, this guy, the CEO, he's incredible. He's made a series of promises on Mad Money, and he's just crushed it. Every single one. There's not been a break of late. Obviously, we would like it to have just like that, but we haven't gotten it. But we'll be prudent when we do buy. It's not running away. I also want to point out, just as the call is going on, Goldman is down 73, and Wells Fargo is down $5.71. I think that people who are just joined, we have a lot of people who just joined, or people who are not interested or or were concerned about, say, a Goldman because it has a high dollar amount, which shouldn't matter. Down 73 is a terrific situation. I just checked in with them. I don't have anything to worry about. They just did the big Anthropic deal. I don't know anything that you can't know inside from anybody. I'm just saying that it's just a great time for them. And Wells down 5. No, that has to be bought.
Yeah, look, we were trimmers of Goldman earlier this year. We trimmed some Wells earlier this year. We were feeling greedy. Yeah. Bought a very small portion of that Wells back. Haven't touched Goldman yet, but finally the valuations are coming down. I mean, Capital One trading at under 10 times earnings for this year.
And this is because
high single digits, when you look at it, just seems very cheap to me.
Right. And they're worried about Apollo, and worried about Blue Owl, and worried about Ares.
And the job market.
And I get that, and the job market. I get that. But these are companies that are M&A. I mean, the ones that we own. M&A leader, IPO leader, Goldman. And Wells Fargo is a company that Charlie Sharp is repositioning and using AI more than anybody else. So I did want to alert people during the call that those stocks have broken down, and those would be the place that I would look at to buy right now.
All right, let's get to an exciting part of our monthly meeting, hearing directly from all of you. So I'm going to get the first one here. And the first question is from Chris, who asks, I've had Amazon stock as part of the club now for several years and have been frustrated by the returns. It is one of my lower performing stocks in my portfolio. My cost basis is pretty low, but I'm wondering if I should sell and transition funds to a Google that has a lot going for it. It's a very great question. I think if you don't already own Google or Alphabet, you could split it up between the both of those. But if you already have Alphabet, I would keep the Amazon. Yes, the market has been spooked by that $200 billion of CapEx, and the expectation is for negative free cash flow this year by about $10 billion. And historically, Amazon has performed best when it is harvesting those previous investments, not when it is in investment mode. So that's the narrative against the stock. But the CapEx is being spent because there's demand signals at AWS. An increase in capacity is what drives revenue higher. And as we've seen from their quarters, as soon as that capacity becomes available, it gets monetized immediately. And that's why the operating margins has been so strong. So I know the long knives are out for Amazon, so to speak, and it has been bad the last couple years. There's no getting around that. But what's happened the last few years isn't changing how I'm looking forward. And I think that what they have going on with AWS and the accelerating revenue growth there is still being underappreciated.
Yeah, look, I just think that in the end, Brian Oslowski is the CFO. I know him pretty well. They're not going to spend any to put the company at risk. I do think that they're not getting credit for the acceleration in Amazon Web Services or Amazon advertising. And the stock is disliked. It's disliked because people feel that its best time is behind it. I don't feel that way. But look, nothing's sacred. I mean, I think that Chris raises good points. And I do like Alphabet more than Amazon. I said that.
Yeah.
And so nothing's sacred. If Amazon can't get rolling at a certain point, we have to decide whether it's Danaher or not. We have to decide. No more Danahers. All right, next up, Brian in California wants to know, why do you think Wells Fargo is best in class as opposed to Bank of America, Citi, or JP Morgan? And you think, as some analysts have said, that the big banks are going to soon be looked at the same way as technology stocks? Love the club, and thank you. Thank you very much, Brian. Wells Fargo is run by Charlie Sharp. Charlie Sharp is probably the technologist who knows more about how to get a bank going. He turned around this bank. This bank was horrible. Yeah. He's done amazing things, but he's not done. He's buying back stock, moving into investment banking. I think he's terrific. Yes, the stock is getting hit today. Yes, it's been a poor stock since the year began, although the February spike was good. But we're going to own it because of the CEO. And I know that you said, well, why don't you own the CEO, JP Morgan, Jamie Dimon? Because it's recognized that he's great. Charlie's not recognized, and he's done amazing things.
Yeah, I was going to say, I don't know if we've ever said Wells is the best-in-class bank. I think JP Morgan, we can all agree, is that. But they do have the best-in-class CEO, and he's done a terrific job turning around the bank, whether it's cutting expenses, increasing investment in technology, building out the investment bank, building out the credit card business, so they're just have more fees and not as reliant on the yield curve. So yes, we bought some back earlier this week, a sliver of what we sold at 86 and 94. Own a lot of banks, which hurts on a day like today.
Sure.
But still like it.
I like this price. I like this price right here.
All right. Now let's go to Daniel in New York, who asks, have your thoughts changed on BlackRock stock? This month has been pretty bad for it. So I was wondering what your thoughts were. Well, you just heard from Jim. And yes, our thesis here has been changing just due to the private credit exposure. We entered the year a little bit more down on it, which is why we cut the position in half. So not as big as we once were there. But it does sound like it's on the chopping block.
This is exactly what I thought. I mean, all the private credit is down, and it's being linked to private credit.
Yeah.
And that's why I want to go. All right. Next up, question for Robert in Illinois, who asks, source of one of your phrases has been rattling around in my head at night. Several of your winners have spent time in that penalty box with a host of $1 trillion IPOs potential on the docket.
Source of funds.
Source of funds. Okay,
yes.
Source of funds. SpaceX, OpenAI, Databricks, and Anthropic. What stocks are likely to be the source of funds? They will be Amazon. They will be Microsoft. Those are the ones that are going to be sold.
So this is the concept where, as new companies come public, there's only enough supply in the market, right? Remember, it's a market of stocks. So when there's more supply that comes on from these big IPOs, potentially $1 trillion IPOs, money managers might have to sell some stocks in order to fund buying the IPOs. That is what this source of funds concept is. So you're saying,
you got to keep.
You're saying Mag 7 because they're the most liquid, the big names.
We'll reference it, but if we were to leave Microsoft, I think I would have to say it is just a source of funds stock right now.
Got it. All right. Next up is a question from Andrew in Taiwan, who wants to know, why is Eli Lilly stock so volatile? I think it's volatile because it trades at a much larger price to earnings multiple relative to the other drug stocks that might have a teen multiple or even a high single digit multiple and have those large dividend yields. So it's the makeup of the stock. It's also very sensitive to what Novo Nordisk is doing. Remember, the GLP-1 market, it is a duopoly, but unlike most duopolies, where maybe they're kind of, I don't want to say colluding, but working together to keep prices high. Novo has been slashing prices, and that's because they need to reclaim market share because Lilly has the superior product. So I think that's what's happening there. But stepping it back with Lilly, I am upbeat about the launch of the GLP-1 pill. Should be next quarter, and I think the demand will be significant. We've seen it with Novo Nordisk, the demand being significant, and Lilly's got the better products, and better products command better prices.
And the drug stocks today are strong. I would tell you that David Ricks, who I spent a lot of time with, has built a moat, and the moat is his factories. He's built a number of factories to do the pill. He's ready. It's going to be terrific. All right, next up, a question from Dave, who asked, there has been a lot of positive news regarding Boeing. Is this a good time to open a new position? Yes, right here. Okay, right here. Boeing has just come down. Boeing's a erratic trader on absolutely nothing. Okay, so you look at this and you say, well, why did it go from here to here? Nothing. I check them in this company constantly, and there is nothing bad happening. It should be 3 months have been good, but down 4? Yeah, go buy it. I mean, I know we recommend a couple other stocks. Well, many stocks. Today's a bad day for stocks, but that's when you buy. There's nothing wrong with Boeing. What's happening at Boeing is they have a huge number of orders. I think the FAA is going to grant them the ability to make even more planes. That's going to help their cash flow, and this company's stock is going to be up much more.
All right, our next question is from Elizabeth, who asks, I belong to the club because I'm a long-term investor and not a trader. I was curious about the reason for the club's approach to selling certain positions prior to events, such as earnings, with the goal of buying them back later. Seems hard to predict. Why not just hold through these events? Well, look, sometimes we'll sell ahead of a quarter because we don't want to be greedy. And if expectations are sky high heading into earnings and they're out of whack, that could lead to some disappointment and a big pullback. Sometimes that works, sometimes it doesn't. But that's just what we've done for many, many years. It has helped us, and more times than it's hurt us. So that's what we'll do. It helped us greatly with Cisco. I think we can all imagine that. The multiple got a little high. We only sold 100 shares, but the pullback would have felt far worse had we kept the full position and didn't take anything. So it's just what we do.
For 40 years, I've sold parabolic moves. We're not traders, okay? We absolutely are not going to get in and out of things. That's for suckers. But when I see a parabolic move, I also think that the parabola is going to lead to this, and it's just been unassailable. So why should we not? We call it schnitzeling. Why should I not schnitzel right here on a parabolic move? It's been right every time, except for maybe for Western Digital and SanDisk this year, and that's why I recommend, and that's why we do it. All right, next up, Nick asks, Booyah, Jim. Booyah. You called CrowdStrike best of breed, but with the stock 35% off its highs, is the market missing the Falcon platform's AI dominance? Is this the ultimate back up the truck moment for the trust? I don't believe in backing up the truck. That often leads to buying too much at one level, which is a mistake to make. When I talked to George Kurtz, it's very clear. He posted a LinkedIn screed about what happened with that newsletter the Monday that I referred to, the pessimist. This is a proprietary company with fantastic technology that happens to have an incredibly high price to earnings multiple, and that's why it's going down. Should we have trimmed the whole thing? It's been a big win. I like CrowdStrike. I think it'll come back, but I'm not. I know it's not immune to what I regard as being the classic case of price to earnings multiple compression.
Yeah, I don't like the back up the truck saying either, because you could know a company cold, you can know the stock cold, but then Block lays off a bunch of people, and maybe there's some disappointment around Zscaler, and all of a sudden you're down. If you thought it was a back up the truck yesterday, you're down 5% on that.
It's just not our
I don't like that. I don't like that. Now we're going to go to Linnea in Iowa, who asked, you recently exited Texas Roadhouse after being a loyal advocate. I recently exited a couple positions because I was impatient. What principles do you rely on in your decision to finally exit a stock instead of waiting out of a bit? Well, yeah, I mean, look, we were loyal advocates of Texas Roadhouse because their customers are too, and that has showed up consistently in those comp sales. But with the stock, we continue to see the stock rally and rally and rally despite beef inflation, the principal headwind the company is facing. There's just been no let up there. So, we know 2026 is going to be another tough year for beef. And if the same happens for 2027, that's going to keep the pressure on margins and therefore earnings per share. So we had a really a good gain in it. We didn't want to give it back, and that's why we exited.
But I mean, they admitted they had to put through a price increase. I don't think the public wants to take that. They had a really bad fourth quarter, but they had a good first 5 weeks, and I don't like that. They had 5 weeks at 8%. They had a really bad comp in the comparable sales in the
December
end.
was bad.
Yeah, and I'm not going to base my, like people went crazy on the good number.
8.2, yeah.
Yeah, so we blew it out, and I don't have any regrets. If steak were down, if cattle were down, price of cattle were down, then I would say, boy, not load the boat up, but buy a lot. And the reason I would say that is because it's a steak place, but it's probably more levered to steak than any other place. And that's precisely the highest area of inflation of all food. And I just don't want to be a part of it. To build the herd up takes 9 months because its gestation period is the same as humans. And so that meant that you can actually predict right now that there'll be a very tight market for beef, for cattle at the end of the year. And I don't want to keep missing the quarter. All right. Our last question is from Dwayne, who asked, Jim, thank you so much for helping me get the courage and knowledge to run my own portfolio. Just wondering if you could give a little more attention to which stocks are on the short list to be sold, and more important, which ones are on your mind most in the bullpen to replace them. That was really Dwayne's question, is what motivated me to try to pivot about how we talked about stocks today, because I wanted to spend more time on the ones that I felt was less comfortable with. And it was very, very hard to talk about Microsoft the way it did. I have a lot of friends at Microsoft and know the company really well. I didn't want to say it, but that doesn't matter. They get the truth. I'm not going to sit here and say, well, look, I really like the CFO, so I'm not going to say something negative. But I was addressed to the idea of what has to go, because we've been doing some selling of positions that we frankly had not going tired of, but just I felt were too risky to be able to have the cash, to be able to buy the stocks that we think are better. And I will again say today, it is Friday. You tend to have, there are a lot of people who are worried about war this weekend.
Yes.
That's a totally legitimate concern. Yeah. But I would say, and that means if I wanted to buy something, I wanted to buy 10 shares of Goldman Sachs, I'd buy 5 now and maybe buy 5 on Monday. But the stocks that we recommend are, I think, there for the ages. We don't trade. And, well, Goldman's probably the cheapest stock in the portfolio now that it's down like this. So anyway, I want to thank everyone. I'm trying to got to get a little more like we are. You have to see, this is how we go down things. This is what we say to each other. I know Jeff probably wants to kill me. I'll come in, I'll say, so what do you think of Texas Roadhouse? And he could very easily say, well, what I said, the same thing I said yesterday. But no, you deserve better. And we grind down and we talk all the time about the things, sometimes the same day, every day. But you have to do that to be a good portfolio manager, and you have to do that to be a good teacher to you. You deserve it. That last question by Dwayne, who is so thrilled that we gave him the courage and knowledge. It's exactly what the club is about. And that wraps up our February meeting. I want to thank you all for those amazing and smart questions. And you know that they are in our minds, and we address them throughout. We love to hear directly from Cramerians. As always, if you missed anything or you want to go back and watch our meeting again, the full video will be on demand, will be available right here. This is the most complicated one. You probably won't even write it down, and you won't do it. And that's a shame. But I don't know why we can't make it simpler, but I'm not in charge. Here's what you go to: cnbc.com/investing-club/live. And that's by 2:30 p.m. I'm sorry it's so difficult. I'm looking over here at Dylan Reebok, who does a lot of our social media. And I think this is the first time we had the social media since I got here that's actually the way it should be done. So I want to thank you all very much. I hope you don't mind that I tried to make it a little more like the banter that we really do. But you need to see how we go about what we do, so you can understand the things that we do well. Sometimes you think something we do badly, but it's the way it works. Thank you very much.